If you're an Australian property investor, I'm going to show you the one mistake you need to avoid that could end up costing you millions of dollars. Now, me and my team have purchased over $1 billion worth of real estate for our clients, and I personally built a property portfolio to over $30 million before the age of 28. And in this video, I'm going to run you through the mistake that so many property investors make, and it costs them millions and millions of dollars. And unfortunately, I've seen this firsthand with my parents who fell into this trap. You'll see on the board, it's a $2 million mistake, because that's what I believe it's cost this person who's just sent me an email. Hi Jack, great news. We've sold the disastrous off-the-plan asset in Canberra that we bought through our self-managed super fund, and the broker has done the numbers for us to buy again. Just to recap, we bought the apartment off the plan in 2012 for $574,000. We've just sold it in June of 2024 for $565,000. As a background, the asset was recommended by our financial planner at the time, who sold us onto a glossy marketing brochure, and it being Australia's first 6-star energy rated building. He received a $35,000 kickback, and then it says, are you still happy to help me out? And we can continue to build the portfolio. This person paid $575,000 for the property back in 2012. Now, they ended up selling this apartment just now in 2024, so 12 years on, 12 years, and they sold it for $565K. So on the surface, you think they probably lost their stamp duty. Stamp duty on a $575,000 purchase is about $27K. They've obviously lost $10,000 of capital value because they sold it for $10,000 less. So there's another 10K, so they're down to 37,000. They've also then had to pay a selling agent to sell that property. So let's just say that selling agent cost $12,000. And let's just assume that during the whole time of holding this property, it's actually paid for itself, so it hasn't cost them any money out of their pocket. And we know that's not true. So essentially, at a high level, it looks like they've lost about $50,000, 50K over 14 years. So you think, 50 grand, not all that bad. We can restart and we can go again. But the reality is they haven't lost 50 grand. They've lost millions and millions of dollars. And let me explain why they've lost millions and millions of dollars. Now, at the same time as they bought that apartment for $575,000, this was in ACT, Canberra. They bought for $575,000. Now, I've done a little bit of research online, and this was back in 2012. Now, at the same time, in 2012, they could have bought in many, many markets across Australia. Now, we buy a lot of property inside of the Newcastle market, so I'm going to use Newcastle as an example. Newcastle's median price back in 2012 was $460,000. Now, this was for the inner suburbs of Newcastle, so the best suburbs in the entire region. Now, this is for the inner ring suburbs inside of Newcastle. You actually could have gotten into one of the best suburbs inside of Newcastle if we were to use the exact same $575,000 purchase price. You could have got into a suburb like Hamilton South, for example. So let's assume that we bought the same property in Newcastle. If we went and bought the exact same property in the Newcastle region for $575,000, and then we held that property for the 12 years of which they sold this one in 2024. We've held it for 12 years. Now, if we were to look at Hamilton South today, and I have the data in front of me, since 2012, the median price in Hamilton South was actually $557,000. So slightly under what this person paid for the apartment in the ACT. And the median value now for a house in Hamilton South in 2024 is $1.735 million. 3 times what the median value was back in 2012. So if this person would have invested in a property in a blue chip established location that had a proven track record of performance, their $575,000 investment would have turned into $1.735 million. 575 into $1.735 million, which equals a $1.16 million gain over that period of time, as opposed to the reality of what actually happened, which was a $50,000 loss. So it's not really just a $50,000, $60,000 loss. It's a $50,000 or a $60,000 loss, plus then the $1.16 million of growth that's then been left on the table. But it's not even just the 1.16 million plus the $50,000 of capital loss that's been left on the table. It is also then what could have been done along the way if you would have had access to this equity. So if we were to go and say, well, we bought that property for $575,000. Let's say that it went from $575,000 to $800K. So we've made $225,000 over that period of time. Now with this $225,000, we've then used that to go buy another $700K property. And let's say that we bought that $700,000 property in, say, 2015, which is what the median house price in Hamilton South was then. So instead of just buying one property for $575,000 in Hamilton South, we've gone, let's let that property then grow to $700,000 or $800,000. Let's get the $225,000 of equity that we now have in this property, and let's then roll that into another $700,000 property. So now we have a property that's worth $800,000 in 2015, and we then have a property that's worth $700,000 in 2015. We bought this property in 2012, and we bought this property in 2015. So if we just look at those two properties now, we've now had one go from 575K, which has gone to 1.7, let me just get the numbers right, 35 million. And then we've also then had a second property which we bought 3 years later, and we've bought that property now for 700K. Even if we said we didn't buy in Hamilton South and we bought on another suburb, that property has gone from being worth $700,000 in 2015 to also being worth, let's assume, 1.5 million. Now remember, to get this $700,000 property, we still haven't put in any of our own money because we got the equity from this property. So it hasn't cost us any more out of our pocket. We've just leveraged off one into the other. And let's just assume that's all we did. We just bought two. So now we've got $575,000 plus $700,000 worth of debt because we assume we haven't paid any of this off and we've paid none of this off. So combined, we've got 1.275 million in debt between the two properties, but we've got 1.5 and $1.735 million worth of equity. So that's our debt level. And now all of a sudden we've got 1.5 and we've got 1.735, which to me equals $3.2 million of equity. The opportunity cost isn't buying the property for $575 and selling it for $565 and then having a capital loss of $50,000. The real opportunity cost is being able to buy this property for $575,000, leverage it into our next property for $700,000, not pay $1 of debt off and still be left with $1.275 million worth of debt in 2024, but then having $3.2 million worth of equity also in 2024, which means that is a gap of around $2 million, give or take. We haven't just left $50,000 on the table, we've left $2 million on the table. And I'm not sure about you, but I would much rather have $2 million in my pocket than $2 million in someone else's pocket. The three key learnings from this, because I've seen this firsthand, my parents got stuck with this person's been stuck in it, and then I've heard the horror stories time and time and time again. Rule number one, never buy brand new. That's rule number one. Never buy brand new. Let that sink in. Now, it might be a generalized rule, and I'm sure there's a lot of people out there who have done really well out of brand new properties, but I can assure you there are a lot more people who have done very bad out of brand new properties than there are who have done very well. If we just have a rule that we never buy brand new, we should never have to come into the issue of leaving $2 million on the table. The reasons for not buying brand new, you heard it before, there was a $35,000 commission that was given to the developer, and people get sucked into buying brand new because they feel like it's free. They feel like, well, it's not costing me anything. My accountant recommended, I'm speaking with this property person, or they're gonna put me into this property for free. But I can assure you, if something is for free, you are the product. And it's exactly what happens in this situation. There is big marketing budgets, they pay big commissions to sell this stock. And if someone has to pay that sort of money to sell these properties, it represents the kind of property that you are buying, right? Because good quality properties sell every single day of the week. So number one is never buy brand new properties. Number two is always look for a track record. And what I mean by that is if there is a long history of consistent capital growth in the suburb, in the region, in the asset that you are buying, that should give you a lot of confidence. Now, if you go and look at brand new, or you go and look at off the plan apartments, house and land packages, there is no track record because they're brand new areas. So it's not like there's been 20, 30, 40 years worth of consistent sales happening, population growing in that area. You're buying into something where there is no track record, there is no data, there is no history, and you are essentially gambling, right? It's like, well, I think this may do well because of X, Y, and Z reasons, and that's what these spruikers sell you on. They sell you on the new town centre that's going there, the new train station, all this stuff which may or may not come to fruition. You know, you heard in this person's example when they sent me the email and they said the reason we bought into it is because of the new 6-star rating. Well, 6-star energy rating now is not even a thing. There's now 7-star rating because of all these new energy stuff. So the thing that they were sold into is now obsolete. So that's why we always make sure that there is a track record of performance. Go on to Real Estate and Domain and CoreLogic and all these websites where you can look at long-term history and make sure that there is a consistent track record of performance. And that means you are going to very much minimize your risk when you are investing, because it is unlikely that if an area has performed for the last 20, 30, 40 years, that it will not do the same or similar over the next 20 and 30 or 40 years. And the reason for that is because we are humans. We obviously have behaviors of humans, and good quality areas that are near good schools, you know, are in affluent areas, just become more in demand as our population grows. And number three, to make sure that you do not have the $2 million mistake, is to make sure you are not trying to make a quick buck. That is one of the most important things. This is where people come unstuck. They go, I can buy into an off the plan or a brand new property or a regional area, and it's predicted to grow by 20% over the next 2 years. Or maybe I can buy into an off the plan, put a small deposit down, and when the property settles in 2 years' time, it's going to grow in value and I don't have to put in any cash. That says quick, all right, folks? Quick buck. There's no such thing as quick money. Let me just run you through the Hamilton South report. 2012, the median price for a house in Hamilton South was $557. The next year, it was $623. The next year, it was $655. The next year, it was $734. The next year, it was $820. The next year, it was $966. The next year, it was $1,010,000. The year after that, it had come back. It went back by about $100,000, back to $908. Then the next year, it was $1,030,000, $1.3, $1.5, $1.6. There is no $1 million made overnight. It's happened over years and years and years of consistent, long-term growth. And that's what we're looking for. We're not looking for $550,000 one year and $1 million the next year. We're looking for long term. So don't try and make quick money in real estate or in any asset class, because that is the fastest way to make no money. That's the $2 million mistake. Never buy brand new, never buy off the plan, always buy established. And if you follow these 3 rules, you too will be able to build a much larger portfolio than what you would be able to do if you fall into the pitfall of buying the wrong asset in the wrong location and it costing you millions and millions of dollars over a long enough period of time.